if there is another side to this story, a next chapter, if that next chapter is the markets start to perform well again, what can I do when the market is down that is good for my financial future? Episode 5.
All right.
Thanks for joining us. We're excited to jump in. What we want to talk about today is just kind of timely, and we're going to talk through kind of actions or possible actions to take during a down market.
Yep. So during times like this, what before we get into the down market side of things, what are the different types of down markets?
So we've kind of hit this a little bit before, but to just revisit, I think it's important to understand that markets go up and down all the time, right? It's part of the risk of being in the market. It's part of the risk of bonds and equities is we're exposed to market fluctuations, right? So in that sense, it's very frequent that we see dips in the market. So typically defined as a 3 to 5% pullback off of a high price, right?
Right.
This happens several times a year. We also see corrections happen. I think it's about
10%.
12 to 18 months, every 12 to 18 months. And a correction is a pullback of typically around 10%, right? We start to define kind of a bear market at roughly 20%. And we see
what we just hit
we see bear markets every few years, every 3 to 5 years. And so the correlation that a lot of people draw on is this notion of recessions and depressions and bear markets. One, so a bear market has to do with the market, and a recession or depression has to do with the economy, and economies affect our markets. So in that sense, I think it's really important to say, because you can have a recession without a bear market. You can have bear markets without a recession. You can have corrections without, you can have all of these things. Recessions don't necessarily lead to depressions. Depressions aren't, as frequent as recessions. So
they're not always correlated.
It's just really important to differentiate. And what we're really trying to do here is provide enough context so you guys listening can keep your feet on the ground and understand where we're at, and really to kind of put in perspective what's going on, so that every doomsdayer that's out there on the radio or on the news is not like over qualifying themselves to scare you to death, right? So in that sense, I do want to take this, kind of put this in perspective from, let's say, like a 40. So a lot of people in our book of business, a lot of our clients are in their 40s. So if you're around 40 years old, give or take, you were born, 1980-ish. By the time, so the first major thing that probably happened that you can remember would have been, this dot-com bubble.
Yep.
You remember it, but you probably didn't participate too much because maybe you were in college at that point. You probably didn't have substantial skin in the game.
Right.
When it comes to investing. So you remember it as an event, but you probably weren't that affected by it. If you're 40 years old, you track through that, you make it through college, you start a job, you start a 401k, and this would kind of lead you into the 2008 depression.
You would have remembered that.
A major financial crisis, right? It would have been probably the first time some of your portfolio was substantially affected by an economic event. it was
And housing
disastrous. I
situation.
mean, housing,
Yeah.
employment, like everything was going wrong, right? Fast forward, and we have some ups and downs, and we have some, 2012 and 18
Well, if you go
and
back
all
and
these
look at
things
markets,
that move.
and some might be smaller than others, like the short little 3 to 5% corrections, the 10% corrections, or you go into the recession or depression. The market always goes through ebbs and flows. It has to go through expansion, then it goes through contraction, then it goes through expansion. Now, how long and how short those are, that's what we don't know.
Right.
But it's always going to do that.
The next thing that a lot of people will think about is something we just went through with the pandemic, right? So in 2020, the market sold off, and if you were exposed to the markets, your portfolio
It hit.
devalued dramatically, very fast. And so I think I want to point that out because there are a ton of other examples of, dare I say, run-of-the-mill recessions. I don't know if that's a great phrase to use, but kind of recessions that were just average recessions. There has been plenty of times that has been the case, but if you're in your 30s or 40s, possibly even your 50s, you have gone through some extreme market scenarios and economic cycles. And what I want to do is just put in perspective that there have been some rule changes, we'll say, to the game of investing over the past few months, largely because of inflation. With inflation, the Federal Reserve has had to try to refocus. What they're not easy anymore. They're doing their qualitative tightening. Interest rates are going higher. The money has changed a little bit. It's a little bit harder to get. So the rules are changing ever so slightly when it comes to our economy and how it interacts with money. So that's why our markets are kind of repositioning themselves. We've been through this before, and in times that, like, historically, when we've gone through times like this, there has been the other side where markets have continued higher after we get through it. So it's typically in history, it's always been that we kind of see the rules change a little bit,
market reacts,
and then we pursue an outcome, and the markets go higher, right?
But I think that what we're talking about here is overall, what we can tell our listeners and our people is you're always going to go through something like this. In your investment career, you're going to go through it.
Yeah, if you're exposed to bonds or if you're exposed to equities, you will see your portfolio change value.
Right.
I think the important thing is just understanding that we don't know what the future looks like. Right. However, we can say that sometimes what we're going through is more normal than, say, a pandemic or say a major depression. Sometimes it's just a recession. Sometimes it's just a correction. Sometimes it's just a dip.
Market. Yeah.
And so I think that's really what we want to start with by laying this context. Hopefully putting some feet on the ground that a down market is something that we typically work through. And there's another side to this story. So the question becomes, if there is another side to this story, a next chapter, if that next chapter is the markets start to perform well again, what can I do when the market is down that is good for my financial future? Right. And so that's kind of where we want to talk today is, we'll kind of some rules, some suggestions, some ideas, some things that we like to see people do when markets are down, and even some things that we're doing for our clients in our own investments while the market is down. So, it's not a time to just necessarily sit on your hands. It's not a time to just kind of play victim to a down market. There's things that you can do right now in the midst of a sell-off, in the midst of a down market, that are advantageous and there's things that you can do right now that you may not necessarily be able to do when markets are high. So it's providing opportunity that's unique, because there was a statistic that I think it's like 12 to 15%, something like that, of the time markets are at all-time highs. Like 85% of the time markets are at all-time highs over throughout history. Only like 12 or 15%, something like that, was where markets are off their highs. And so if that's the case, we definitely have more opportunity to do to invest money when markets are high than we have when markets are low. So in that sense, let's talk about rule number one.
Yep.
This is something that applies to every single listener. There's some things that we say are good for some. We're talking to a broad audience. Not everything that we say applies to everyone. So you have to kind of digest this education and say, is it relevant to me? Can I apply that? But in this case, rule number one is good for everyone.
Yep.
Don't panic, right? Like, just don't panic at all. Yep. So again, we can work through this methodically.
Right.
We can make decisions that are informed. We can make decisions that are healthy for us. We might even have to make a decision that isn't great for us, but's necessary
at the moment.
But we're not going to make a decision just purely out of fear or purely out of panic. So don't panic is rule number one. That's pretty straightforward.
Decisions based on emotion.
We don't fear sell. We don't fear buy. We don't panic sell. We don't panic buy. Yep. That can also apply at times where market's running higher. A lot of euphoria is out there and people feel like, oh, I got to get money in. Just buy. Just buy something. I heard this from a friend. Buy it today. Yep. Have we done homework yet? No, we're not gonna panic buy. We're not gonna panic sell. And in this case, because markets are down, we are seeing a lot of people start to make decisions or have conversations from a position of being scared. Mm-hmm. So we're not gonna panic. Rule number two, and I think again this also applies for anybody and everybody that's listening, and that is revisit your risk tolerance. So every platform that I know of, every single place where you can go to buy a stock, a bond, a mutual fund, an ETF, they have resources,
have a questionnaire
where you can take a risk tolerance questionnaire.
Some are more in depth than others.
Some are. If for whatever reason you don't have access to that risk tolerance questionnaire, you can't find it, or you don't know if your institution or person does have that, go to our website. We have it. It's free. So you can
scroll down,
click on it,
the test,
take the quiz, and find out your tolerance for risk versus reward.
And this test, again, going back to like our maybe second or third podcast, this is more of a psychological test than it is an actual monetary, like factual test. So again, when it comes to investing, the don't panic, checking your risk is more based on the psychological side of money.
Yeah, and I think that ties into this notion. A lot of people, when they get started investing, they're typically kind of excited, or they're celebrating, or there's a little euphoria. A lot of people that are brand new to investing aren't coming in right now to the market. Right. We understand, like there were a lot of new
investors in November, December this past year, and that euphoria was really kicking in. There was a lot of new investors. And even some of our clients, and right now they're hurting.
One of the oldest adages, one of the oldest sayings in investing is, everybody knows it. We buy low, we sell high. I'd argue that is the hardest thing to execute on.
Right.
So when people typically get started in investing, when people typically come down and sit down, a lot of times, not all the times, but a lot of times they're coming in because things are going well. So they got a new job, they got a raise, or they've heard, their neighbor is getting some great returns, whatever the case may be. But they're coming in with a sense of excitement. They're coming in with kind of this, superhero mentality, like I'm winning.
Come in,
so a lot of times when we give that risk tolerance questionnaire, they're answering it based on this idea of, I can't lose right now.
Right,
Right?
yeah.
Nobody's losing right now. So if that's the case, let's go ahead and retake that risk tolerance questionnaire when markets are down, when we're kind of getting beat up. There's some people getting laid off. Mortgage. If you're shopping for a house right now, you're
Right.
just getting slapped in the face with a 5 to 6% interest rate offering. A lot of hopes and dreams are being kind of delayed. People are getting humbled. So in that sense, I think this is a great time for every single person to revisit that risk tolerance questionnaire. So if you're working with someone, call them. Hey, can I take this? If you're working with an institution on your own, typically they offer it. If you can't find it, if you don't know where to go to our website and you can take it for free. Now, the next thing that you want to do, kind of along with the risk tolerance piece, but it is different, is revisit your goals. Okay. So this is a great time, again, from a place of a little bit of humility, a place of not so much euphoria, to understand what really, really matters to you.
Right. What are you working towards? I always ask people, what is your why?
What is your why?
That'll get you to the end. During times like this,
So not only
about what you're doing.
are we making sure our goals are appropriate, not only are we making sure that our goals are actually important to us, but through this process, as we decide these things are matter of fact important to us, it lets us know, hey, this is why we're enduring this sell-off. Things are hard, things are scary, but I'm not going to panic because this is really important. And I knew from the start that markets go up, they come down, they go up, they come down. It's part of the process. It's part of the journey to get to insert goal.
And another great question to ask yourself is, will this current market downturn, the current market conditions, will this deter you from reaching your goals? More than likely, it's not. If you have set goals, you have a plan, more than likely,
and you're doing disciplined investing.
Right. Which brings us into the next.
Yeah. So the next thing that so just to catch up, we're not panicking. We revisit our risk tolerance questionnaire, make sure we're risk appropriate in the decisions we're making in our portfolio. We're revisiting our goals. We're asking ourselves, why? Why am I doing this? Why am I putting money away? What am I working towards? Are my investments aligned with my goals? Is my money kind of disconnected from what I want in life? Is my money connected to the heart of the matter? After we do all that, we remember why we're doing it. We know we can endure whatever we're going through because markets come up and down, and we're not derailing our financial future because of a market turn down. Now we can say, okay, step 4.
What are some strategies?
Step 4 is dollar cost averaging. Okay. Why is dollar cost averaging so great in a down market? Because nobody can predict the bottom. Just like when markets are high, nobody can predict the top. People will make you think that they can. We use a lot of stats. We use a lot of history. We use a lot of analysis, both technical and fundamental. We use a lot of ideas to say we think, but nobody knows. Right? So if I can't predict the bottom, let me just dollar cost average in, because time and time again it works. It's one of the oldest time-proven strategies for success.
There's a ton of stats out there if you just go on the internet and look to see if you try to time the market and you miss the top 2 down days, or you miss the top 10 up days. If you dollar cost average, more than likely you're going to be in a better position, and it's less emotional.
Exactly.
Over time.
So we don't get caught trying to time the market, right? We're not going to sell everything today and try to come back whenever because we're just not going to time it. We're not going to time the market perfectly. So let's keep dollar cost averaging, whether you do it weekly per paycheck, monthly per per, just on the 1st or on the 15th.
Right.
There isn't a lot of,
there's not a
there's not a lot of poetry. There's not a lot of creativity that goes into it. You just
Right.
pick, like, if you want to do it weekly, if you want to do it monthly, if you want to do it every 2 months, if you want to do it once a quarter. Dollar cost average is dollar cost average. You just make a decision and say, hey, this is how I'm going to contribute.
Yep.
Every, we typically, a lot of our clients either do
monthly.
like the 1st or the 15th or both, so there's not, you don't have to really wonder. You can look up dollar cost average, you can read all about it, but essentially you're just picking a time to put money in, and it's small contributions over a lot of time. All right, dollar cost averaging. So next we move on. In down markets, this is a great time, especially if you're self-investing. What we're doing for our clients is going back to the portfolios and looking at our homework again. So I mentioned earlier that typically recessions or corrections coincide with the rules of the game changing a little bit. In this case, inflation is up.
Right.
Inflation is up. And because inflation is up higher, the Federal Reserve has had to start tightening their monetary policy. Interest rates are higher. Assets are getting sold to the marketplace. Right. There's a lot of things changing about some assumptions that we were making a year ago.
Right.
And that's exactly why we're doing this. The market is just repricing and looking, saying, how do we approach this new set of rules? So with that, did any of the rule changes change the assumptions that I made enough that now this investment that I was making is no longer a good investment
For the plan, for your plan,
for the portfolio?
Yeah.
So what's really problematic here, again, understand, if we decide that we're going to sell something during this time period, it's not out of fear.
Right.
It's out of fundamental homework, right? So we can still come to a conclusion that the rules have changed enough.
Right.
That
does it fit in our plan or does it not fit in our plan at this time with the rule changes?
Right. And so we might need to sell something. And that's okay. And what we don't want to do is there's a behavioral kind of thing that happens to people, especially in finance. We call it anchoring. And that's this notion that if I seen ABC company at $100 a share before, that is the actual price it should be, even if it's at $50 a share now. It can come back. Just because we've seen it somewhere before doesn't mean it's coming back. And that can work the other way too. We might say, hey, I really, really think that ABC company is a great investment. I want to buy ABC company and add it to my portfolio, but I've seen it at $50 a share before, so I'm going to wait till it goes back down to 50 in order to invest. Sometimes this notion of anchoring to a price, we might see it as something. There's a great way to do this too. If I go to Google and I look for a flight from Nashville to Cancun, and I see, like, if I Google it right now, I pull it up and I see the price at $1,000. If I come back tomorrow and I see it at $1,200, my reaction, like, man, I should have bought that yesterday.
Right. But if I see it at $1,200, and then the next day I go look at it and it's $1,000, I'm like, oh, that's a.
Well, I think if you've seen it at like 1,400,
yeah,
and then the next day you come back at 1,200,
I'm like, oh, that's a great price.
Now you just got a great deal.
You think that's too expensive,
right? So we're anchoring the prices there, and I think that the idea that we shouldn't anchor, we need to do our homework. This is a great time to say, okay, what's in my portfolio? Is anything need to get out of my portfolio? All right, so those are kind of the big things that I think we can all do. We can all take advantage of, especially if we're actively contributing. The only thing that might be different is if you're not actively contributing to your portfolio, maybe you're already in retirement, the dollar cost averaging may not apply so much.
Right.
But as far as don't panic, check your risk tolerance. All this boils down to having a financial plan. I think it's so important. I do have some clients that have called and said, hey, Brandon, I need this sum of money. And it's like, man, if we would have been able, like, this is something we could have planned for.
Right.
Sometimes things come up.
Yeah.
If a storm rolls through and your roof blows off, there's no planning for that per se, right? Things happen. But there are other costs where we could have looked ahead and said, oh, we should have had cash, or some of this should have been in savings and not invested in the market. because we knew this expense was coming up.
Yep.
Having a plan is so important because we can work cash flows. We can make sure there's, risk appropriate investments for different types and time periods. All that factors in. Having a financial plan is so important because it alleviates so much stress of your portfolio being down 15, 20% because the money. So a lot of our retirees that we're working with, they may not like seeing their portfolio down,
right?
But they know the cash that they need is in cash equivalent investment vehicles. So even though their portfolio that's exposed in the market is down a little bit, their income is not changing,
right?
Because we have planned
Correct
for that, right? So in that sense, if you are contributing all 5 of those things, don't panic, risk tolerance, revisit your goals, dollar cost average, and do the homework on your portfolio. They all matter. If you're in retirement and you're not contributing, the only one that wouldn't apply is dollar cost averaging.
Right.
Okay. Now, 2 things that we're working on for some of our clients, and we're going to put it out there.
Yeah, these are strategies that we use.
This is not advice. This is education. This is an idea for our listeners to research. This is ideas for our listeners to take to financial professionals.
We're not telling you to do this.
This is very, very clear that this is not something. So all 5 of those things that we already mentioned are pretty applicable broadly.
Right.
The next 2 things are not necessarily applicable broadly, but it's something to consider if appropriate. So we're going to put it out there.
Talk to your financial advisor.
Consult a financial professional.
Yep.
Do a ton of homework if you're doing it yourself, because this is something that could be very... this could have negative consequence if it's not appropriate and you do it. Okay. Yep. But in that sense, down markets in taxable accounts, it's a great time to consider tax loss harvesting. Okay. So we're going to leave that at that. One thing, if you do act on this, you do need to be aware of all the
tax laws,
like wash sale laws and things like that.
Talk to your CPA, talk to a tax professional.
Yeah. It's very important that you do this the right way.
Cannot give tax advice,
so
vice versa.
Just make sure that you, again, that's not instruction by any means to everyone. Just it's an idea for you to explore. The other thing that is, if appropriate, it's a good idea to research. It's a good idea to understand your situation enough to know if this is appropriate. It's also a great thing to talk to a financial professional about. Is maneuvering assets from your taxable, liquid accounts, your taxable accounts, into qualified accounts, and investing in the qualified side. So the flow of money, if I want to put $6,000 into my IRA this year, before maybe a price, maybe $6,000 would have bought 3 shares of ABC company.
Right. Now it's buying 7.
But now I'm potentially buying 6 or 7 shares. So kind of getting more bang for my buck, so to speak. So a lot of our clients that are investing in qualified accounts, whether it's a 401k, a SEP, a simple, whether it's an IRA, either traditional or Roth, anything that they have access to that they are contributing to, a lot of them participate on monthly contributions. Right. Sometimes you just can't. Sometimes you're working with a CPA and you just can't contribute money until next year. Once you find out how much money you've made.
Correct. There's
some limitations there. So again, very important to work with the CPA on this. Talk to a professional about how this can work for you. But if we're in the month of June, maybe I've already contributed about $3,000 to my IRA over this year. It might be wise if I have some non-qualified money to go ahead and just put $3,000 more into my IRA now,
right?
And get that invested because again, we're getting more bang for our buck, and it's just we're creating a more down the road tax efficient picture for ourselves by investing when the market's down low. So that's just something to consider. That also goes for Roth conversions. You're again, something to explore. It's not for everyone. Some people just can't even do it. So definitely something to explore with a professional. So that kind of sums up, again, those last 2 things are more ideas for you to explore. definitely not advice. This is purely about educating you guys to make, kind of decisions. At the end of the day, we just don't want people panicking. We don't want people making fear-based decisions in their portfolio, because that's where people get burnt. I hear stories all the time about people that got burnt in 2008.
Yep.
And a lot of the people that got burnt in 2008, some of them were just taken advantage of. Some of them, there was definitely some illegal stuff going on, but many of them just made a decision out of fear to sell when the market was already down, and it took them. Some of them are still recovering. Some of them haven't recovered.
Some of them are still in cash.
Yeah,
and they never got back in the market.
They probably came back in last year in November.
Yeah.
So don't panic. So again, don't panic. Check your risk tolerance. Revisit your goals. Understand your why.
Yep.
Make sure your money and your investments are tied to your goals. They need to be connected and not disconnected. Dollar cost average is a great practice for those people contributing to their accounts. We're not going to try to time the market. That never works. Do your homework on your current portfolio. So revisit those fundamental, reason. Like if you made an investment decision, revisit the fundamentals that led you to make that decision, and do those fundamentals still math out correctly.
Right.
And then that step 6 and 7, purely educational. Yep. Things you can consider or do homework on, tax loss harvesting.
Talk to your financial professional, talk to your tax professional for those ideas, and if it's applicable to you and
you're
your
always
situation.
going to, yeah. So tax loss harvesting and maneuvering assets into your qualified accounts to include Roth conversions. All right, so that wraps up. Any final words?
Nope. Wraps
So
up the market downturn.
Yeah, I think these are things that we can do. We can explore. We don't need to just sit on our hands and pout that the market's down. We can be proactive. We can be considering the other side of this story. The biggest thing, guys, is we're not defeated. It's just a revaluation process, and the market's looking for the path out. Many, many times we don't even realize that we're in that recessionary period before the market starts to come back up. So again, don't try to time the market. We might get some sort of affirmation about what kind of economic cycle we're in, and the market could already be coming out of what we've been through. Mm-hmm. We're not calling a bottom at all. That's not what this call's about. We don't do that. We're not saying that this is something that's going to be short-lived, or it could, it doesn't even matter. What we do know is that we can't time the market, so we'll stick to some fundamentals and we'll do the right thing on the way out, on the way through this. So, reach out, www.harpethwealthpartners.com, if you want to take that risk tolerance questionnaire. Send emails, call us if you have any questions. We'd love to hear from you. If you guys have any ideas about, talks that we could do, shoot us an email. Let us know what you want to hear about, and we'll talk to you soon. Thanks.
We hope you learned from our conversation today. It is important to us that you know this is for educational purposes and not intended to be considered specific advice for any individual listener. If something we discussed is relevant to you and you have questions of how it might be applicable to your specific situation, please reach out to your financial professional. Of course, we are happy to have further conversations with you regarding specific questions or applications to your individual financial situation. With that, here are a few disclosures. Securities offered through LPL Financial, member FINRA, SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Harpeth Wealth Partners are separate entities from LPL Financial. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Hypothetical examples presented are not representative of any specific investments. Your results may vary. With that, thank you, and we look forward to having you back. Take care.